Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Moore's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Moore who find excitement in delivering on Be Boring, Make Money. On this episode, we tackle one of the three tenets of our investment philosophy, investing at a discount to intrinsic value. Justin Anderson, equity analyst and leader of the lab here at Moore, walks us through the definition of intrinsic value, how we model it, and some of the ways it might be influenced by technology now and in the future.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
All right, we're joined here today by Justin Anderson, who's an analyst on the Canadian equity team. He's also kind of one of our resident valuation, I don't know what we call you. You are part of the lab. I want to call you a valuation lab rat.
I'll take that as a compliment.
Okay, good. So we'll start there. In today's focus of the podcast, we want to focus on intrinsic value. So Justin, you've been doing some modeling and trying to automate and all sorts of data stuff, and it all leads back to Moore's approach on defining intrinsic value. The reason we got on this subject in terms of wanting to record a podcast on it is maybe an opinion that intrinsic value as defined in the finance world gets used a lot, and not a lot of people stop to define it. So I'm going to steal some airtime here. So welcome, Justin. Glad you're here.
Great to be here again.
Awesome. But I mentioned definition, and I have in front of me a paper copy of a dictionary. Oh, no reaction from the crowd. That's okay. I'll prove it. Okay.
Legit, people. It really does have one.
Yeah, I do. So I'm going to look up both words, one intrinsic, one value, and see where we get at on a definition. So intrinsic, adjective, inherent, essential. There you go. And then value. Value, noun, worth, price, equivalent.
There you go.
So inherent price.
Yeah.
So that's the intro. Intrinsic value. For you, Justin, do you agree that it's maybe an overused term? And if it is, give us a definition.
No, I think we can get kind of stuck into definition details. I think when we talk about intrinsic value, all we're talking about is what is the value of a company in this case, right? The question of what is the value of something, this is like an age-old question, right? It's like a big question that people always ask. When you go into the supermarket and you're buying carrots, you're asking yourself, what is the value of this thing to me? And then you're looking at the price of the carrots and you're making a judgment call there whether the value is worth it.
Depends how much vitamin A is in it.
Well, that can affect the price. So there's the attributes of the carrots, right? So, economists have been struggling with this question of what is something worth for many years, right? It's like David Ricardo, Karl Marx had this labor theory of value, and there's the subjective theory of value. So there's all these different ways that people, have looked at this and said, well, what is something worth? We have an advantage because we're valuing not something like different from money, like say carrots, where it's like you have to make some kind of utility call of what it's worth. But we're valuing something that's producing money. So we're valuing, in a sense, cash itself. And that's a lot easier because you don't have to make kind of as many value judgments on whether or not this is something that I want for myself or somebody else wants for themselves. We're valuing, when we talk about intrinsic value of a company, it's like, oh, what's the cash value of this thing? So the way to think about it, to make this very simple, right, is you can say, I can ask you a question and say, okay, what's the value, if I give you $100 now, what's the value of that $100? Well, it's $100. Pretty obvious, right? So that's simple. Well, then we can make it a little more complex. We say, well, what if I give this to you in a year from now? And then you say, well, I'm not going to pay $100 for that because I could invest $90 and make 10% return on that, and I'd have $100. So I'll probably pay you $90 for that. So that we call that the time value of money. So that's one reason why the intrinsic value of a company, when we're looking at that, we have to discount. We call it discounting that future cash flows that we're expecting to get from the company. We have to bring it back to the present, and that's time value of money. There's other factors that go into it as well in the future. So it may be that I offer you $100, but you're not certain that I'm actually going to pay you $100. Maybe I'm one of those friends, that you lend money to and never pays you back. I think we all have a couple of those. So, if that's the case, if it's the friend who's uncertain, then you might discount it even more. You might say, you know what, I only think that's worth $50 or less. So, and that brings in this idea of uncertainty in the future cash flows. So when we're valuing a company, all we're doing is that we're asking a very simple question. It's like, okay, what's this $100 worth? Under the fact that we're actually going to get that $100 sometime in the future, and there's uncertainty about how much of that's actually going to come back to us as equity owners. So that affects how much we take that $100 and we bring it down to a different number. I would call that intrinsic value.
So that's clear in terms of cash flows. But in order to produce cash flows, companies have assets. So Nike has factories. Those are assets on the balance sheet. So certainly the assets and liabilities of a company factor into overall valuation. So give us a sense of how that comes into discounting cash flows. How do we roll everything up? Because to me, intrinsic means everything the company's about.
Yeah, I think so. You get into an interesting question around if a company ceases to exist as a going concern. Oftentimes what they'll do is they'll sell the assets, they'll pay off all their loans, and then whatever's left will go to the shareholders. And that might be a very different value than the value if those assets are producing goods that they're selling as kind of a going concern type business. So it's true that we definitely look at we call it the breakup value of the company. And that would be where the balance sheet would be particularly important and it would play a bigger role because you'd want to see, okay, what does this factory make in the market? But I think, 99% of the time, we're looking at more of going concern type companies where we're projecting future cash flows and then bringing those cash flows back to the present. And the assets are very important because the assets are the ways that they generate those cash flows.
Right. So, and for growth purposes, a company would invest in more assets to create more cash flow.
And the debt is also very important because you remember we opened with this example about uncertainty, about your friend who doesn't pay you back, right? Well, if you have a lot of debt, there's a higher probability that the company is that friend, right? It might not pay you back as the right. Equity holder, right? So that's the reason why we also look at the debt side, and that's very important when we're trying to assess, well, how much should we be willing to pay for that? Because if there is a lot of debt and there is some risk that they might not pay it back, well, then that brings it down significantly.
Once we come up with an estimate, what do we compare that to?
Well, the obvious one to compare it to is the market price, right? So it's like, that's sort of the 101 version is just what's the intrinsic value of the company and what's the market price telling us? And if we see a big difference there, then we might get interested, obviously, if the intrinsic value we think is worth more than the current market price.
Okay, so from there, let's jump into tools, Justin. So what specifically, if you're valuing a company, what specific tools are we using? And then maybe we can get into a little bit about how we're improving them over time, but let's start there with what tools you use.
Yeah, sure. Well, we use a lot of tools. So the core tool I would say is a discounted cash flow model, which is something where you do exactly what we've been talking about. You project cash flows based on the existing assets and what you think the future is going to hold for the company, and then you discount those based on the risks involved. So it's very much along the lines of what we've been talking about today. Okay,
so bare bones, you're sitting at your desk, you have a monitor, you have Excel open.
I always have Excel open.
Me too, yeah. I'm spreadsheet dependent. I can't add numbers in my head anymore. It's just like
I've got a sickness. I'm just too obsessed.
So I'm just trying to give listeners a sense of, yes, it's a Microsoft Excel model, but let's walk through some of the line items actually in a company's cash flow model that we actually estimate.
Well, some of the things I would say would be top of mind. If you had to say one very important valuation metric, it would be return on capital. Okay, so if we think about these companies as these little cash flow machines, right? That we have to spend some money to buy this machine, and then it kind of spews cash over time, and we want it to spew more, obviously. The ability for that company, when it spews cash, to take that cash and put it back into the company so that it generates even more cash in the future, that's return on capital. So that's the ability for the company to put money back in and generate even more than it did. So that number is really important. It's the foundation for kind of what we look for in companies, especially at more. So I would say that's one important thing. Another important factor is, well, if you do have this company that has this high return on capital. So it's the kind of machine that we like, where it's going to, if you put money in, you're going to get a lot more out. Well, then you got to look at the runway potential of the company. So this is, well, how much times can the company actually do that process of injecting more money back into the company? If they already saturated their markets and they got nowhere to grow, so this is growth, well, then it's not as interesting. You might have a very high return on capital, but you don't have the growth opportunity. An example company like that would be Apple, right? Apple has extremely high return on capital. It invests and it makes a whole bunch of money on its iPhones, very successful, but it's a very saturated market. And they already sort of dominate the market. So it's very difficult for Apple to be able to take advantage of that high return on capital in the future. So that means that in the case of Apple, that might be less important. You might contrast that with a company like, say, Shopify, right? Which we actually own in the Canadian Equity Fund. And that's a company where the runway potential there is very significant. They're just starting, at the beginning of the journey, let's say, and they've got the high return on capital. So that potential to deploy that is very high. So return on capital is not always the same for every company in terms of you might have the same level of return on capital, but two different companies might benefit very differently from it.
What other line items are we? I'm trying to get. Man, I got
to show you one of these models, Cam. What else is there? So you start with revenue that's growing at some rate, and then you take that revenue. You have costs in the business, right? So that we call it COGS, and that you break that down, and then you've got other costs like SG&A in the company, and eventually you get down to sort of your income that the company is generating, and then from the income you're sort of paying some of that to dividends to your shareholders, some of that you're retaining back into the business and reinvesting. Yeah, so that's basically the kind of the typical model is broken down like that.
Do we forecast one single number? So we're talking intrinsic value. So for every company we own or every company we run a model on, do we have one single number?
Yeah, at the end of the day, it boils down to a single value of what the company is worth under that particular scenario.
Okay, so listeners are probably waiting to hear what Shopify is worth. What's the single number, Justin? Tell us.
It's interesting because it's a good segue into how we think about doing our modeling at more. So one of the issues is we actually don't really like looking at a single scenario and sort of saying that's the scenario. So I wouldn't tell you what there isn't a single intrinsic value for Shopify. There is under a certain set of inputs. If I put a certain set of inputs, I'll get a certain output. But we, at More, the way we kind of look at our process is that any given company doesn't have a single kind of outcome that is kind of the narrative that we're attached to. We actually see the world in a kind of more stochastic term, so a very probabilistic. There's a range of potential scenarios that that could turn out.
Right. So within doing that, that's the uncertainty, right?
That's part of the uncertainty. I think there's a lot of uncertainty. That's the uncertainty that we can try to project. There's a lot of uncertainty that we can't project, and that's part of the discount rate.
That's great, Justin. So if it's a range, how do you capture that in the model?
Yeah, so we use this well-known technique called the Monte Carlo simulation, right? So in a Monte Carlo simulation,
do you have to get on a plane, go to Monte Carlo, and go to the casino?
This is one of those. It's like Google Earth. You don't have to get on a plane. You just run it. It works.
Cool.
And so the Monte Carlo simulation, what it is it's just, you can think of it as a bunch of scenarios that you run. So, and typically thousands of scenarios. So you might say, okay, let's run this over 1,000 scenarios and for each time we run an iteration of this Monte Carlo simulation, we're going to use slightly different inputs. So we're going to define the range of inputs for each input, say, hey, this margin we expect could range from this to this, the growth could range from this to this, and then we feed that all into this Monte Carlo simulation, and what comes out is an output that's also a range that says, okay, well, the intrinsic value could be anywhere from, $50 per share to $70 per share based on the inputs that you've provided me. So that's definitely how we look at valuation. We don't look at a single number. We look at a range of numbers.
Okay. So we're getting into statistics land almost in terms of using Monte Carlo analysis and running many scenarios. Do we use any set type of distribution? So really, I'm digging into statistics here, but are we talking a normal distribution? Are we talking some kind of skew? What's our approach there?
Yeah, we use all of the types of distribution. So an example would be in oil and gas. We would use a lot more of a log normal type distribution, which is indicative of the underlying nature of geology that goes into an oil and gas model. So if you're modeling the outcome of drilling a well, for example, then the outcome actually follows a log normal distribution. And that's well documented in nature. And so we see that. So for that case, we won't actually say, well, we think this well is going to produce X amount of barrels. It's actually going to produce a distribution of potential. And then we define that as log normal. Many times we use triangle distributions. Other times we use normal distributions. So it just depends on what the nature of the input is. And we try to match that with reality as best we can.
Wow. So there's a good degree of sophistication there that's underlying that monitor that's showing you the
at least that's where we target. Doesn't mean we always get there.
Right. All right. So just to sum up where we've been, we're now in the stage where at Moore we're coming to a range of estimates within our estimate for intrinsic value. You touched upon discount rate. So let's talk about, and that's particularly important, I guess, if we're looking in the environment currently and there's signs of inflation and rates are going up. How do we capture kind of cost to capital within our discounted cash flow model, and how often does that change? Like, give us a dynamic view of how we look at discount rates.
Yeah. So first, to understand the concept fully is let's come back to that initial discussion that we had about the $100 in a year's time. So that $100 in a year's time, it might be worth $90 today. It might be worth $50. It might be worth $30. And those different numbers are a function of how much risk there is to getting that money back at the end of the year. So the actual mathematic embodiment of that phenomenon is the discount rate. So you would use a higher discount rate in the case that it comes back to, say, $30, and you'd use a lower discount rate in the case that it comes back to, say, $90. And then the question is, okay, well, we know in our minds it's something to do with risk. So then how do we actually get the number to define how much risk there is and how much we should actually discount those cash flows by? And that's a function of a few things. So one important factor is the country in which the company is operating. Because the country in which the company is operating is going to have a different set of risks associated with it. So we actually look at the yield curve for the country in question, and that yield curve is going to give us a benchmark of other investments that investors could actually put their money into. So that's the starting point. It's like, okay, well, you could go put your money in the yield curve, or you could buy this equity. So that's kind of your lowest risk option. If these things were zero risk, that would be your discount rate. Would be
so that's the friend that pays you back.
That's the friend exactly.
Almost without asking.
That's right. That's the friend. That's the sure friend. He's the yield curve. That's the competition. And then you can go down and you say, well, what's next? Well, then there's inflation. So inflation, meaning that the money's going to be worth less in the future. So you need to be compensated for that. So that's going to increase the discount rate. Then there's risks that the company's going to default. So now we're getting into things like corporate spreads. So this is what we do is we look at the typical corporate spread on different bonds and compare those in the country in question, and we apply that as an additional risk because you're going from government debt to effectively corporate debt. So we're basically building it up. Technically it's a build-up model, and eventually we get to a point where we add a equity risk premium, which is sort of the extra amount of return that I require as an equity investor because I'm taking on more risk. So we add that, and then finally that gets you to your cost of equity. So and then all the cash flows that are coming to the shareholders, we discount them at that cost of equity.
One term in there is the equity risk premium, and in my experience in the industry, that's kind of just throwing a dart, right? So I don't know. You look over time, and lots of literature would suggest that there's a number out there that's a typical equity risk premium. But how do we view that? Like, is it we know the company's well enough to say, well, over time, this type of company deserves this type of premium, or we want to earn this type of premium? So let's just walk a little bit through that.
Yeah, it's a great question. And I think it's important because oftentimes we do spend a lot of time on projecting cash flows and not necessarily thinking enough about the discount side as an industry and what goes into that discount rate. It's interesting because it's a question for the Moore lab that we've been spending a lot of time looking at is specifically equity risk premiums. And how do we actually go about projecting what that should be? So the idea behind the equity risk premium fundamentally is trying to capture that risk. We already talked about that. It's like how much additional risk there is for being an equity owner because you may not get all those cash flows back. There's different ways that you can go about trying to suggest what an equity risk premium should be for a given company. So one thing you can do is you can look historically and you can say, well, in the past, this has been the average returns, and therefore the market is sort of suggesting that this is the equity risk premium. There's another way to do it, which is implied equity risk premium. And this is my own preferred way because it's forward looking. And what you can do is you can look at the the current index. So take, for example, the S&P 500. You could look at the S&P 500 and you can then look at the constituents of the S&P 500 and you can see what analyst estimates are for growth in those constituents and expected dividends that are going to come out of those companies over some period of time. And then based on those projections, you can actually back out from that on a forward-looking basis what the market is implying that the equity risk premium is given the current index price. So that's a very powerful technique. We're starting to explore doing that ourselves. We've done more of a historical approach at Moore, but in the Moore at the lab, we're looking more at leveraging these implied values that are coming out of indexes, and that's something that should be coming out over the next few months.
Okay, so that's a great answer, and it tweaks another question for me in terms of do you ever reverse engineer the model? So you take the market price and say, okay, what does the market price imply about intrinsic value or equity risk premium? Am I on the right track there in terms of if we're looking at forward-looking stuff? Or
yeah, well, first of all, I got to say I like the question, and the reason is I think you're touching on a very sensitive subject for our industry, which is people tend to, when they're building the models, they're very aware of what the price is. So it's very tempting as an analyst, as a human, right, to go in there and say, well, the market is saying this, and I don't want to look like an idiot, so I'm going to put in these inputs that turns out matches the market pretty nicely when I look at the output. This is a real problem because what happens is you're not actually trying to answer the core question of what is the intrinsic value. You're more just repeating what the market is telling you. And it may be that the market is correct, and that's fine, that you can have that debate. But I think as analysts, you want to try to be as blind to the market price as possible when you're building your assessment of the intrinsic value. So one of the ideas that we're, again, working on very hard in the lab is this idea of building interfaces between the human analyst and the machines that generate the valuations, and trying to make those interfaces a little more opaque. So it's not as easy for the analyst to see exactly what the output is from tweaking a given input. They can see it after the fact, but not when they're going and actually building the model in the process. So that man-machine interface is front and center right now in the lab, and something that we're working on.
So Justin, I really enjoyed the exploration there in terms of opaqueness. But you said lab many times, so I just want to pause and give listeners a sense that we had you on before, and you talked about Moneyball and automation and how we're trying to get to that at Moore, and you're kind of king of the lab, so to speak. So just a plug there for if listeners want to learn more about the lab specifically, you can go to our website and find it there. I wanted to continue a little bit more on I guess overall in terms of automation, artificial intelligence, and get your sense, Justin, just more personally as opposed to how we're trying to apply things specifically at Moore. But where do you see valuation going in terms of, can you teach a machine to do like 3/4 of the work? Like where's the human judgment going to be in the future? Or is there going to be human judgment at all? Maybe that's the ultimate question. It's
a good question, and I think something that a lot of people are thinking about right now. My take on it is I think it is sometimes a little bit overblown, the idea that sort of the computers are going to take over everything in investing. I think the problem with that thesis, here, I'll give you an example. So one of the most basic activities you would think as a human to train someone to do is folding laundry. Okay, it's very simple, right? I'm personally terrible at it, but it's something.
A fitted sheet? Who can fold a fitted sheet into a perfect rectangle?
Well, there's perfect folding, and then there's my folding. So basically, those are very different things. But the fact is, teaching a machine to fold laundry, that's a hard problem. People have been trying to do that. There's all these like $1 million devices that are attempting to do it, and they're still horrible compared to a human to do it. And yet, computers are flying planes, and they're landing planes, and they're doing these, they're taking people to the moon, and they're just doing these incredible feats that are just unheard of. So it's like, well, you can't fold laundry, but you can fly a space shuttle. Like, what's going on here? And what's going on is context is so important. So certain questions are very suitable for humans, others are very suitable for machines. And what we're doing at the lab is we're trying to break those. We're trying to figure out what's folding laundry in investing and what's flying planes. And that's something that, we're making a lot of progress on. I talked about human-machine interfaces. That's part of that. I'll give you another example. So humans, for example, humans are very good at depth. We're good at diving deep on a specific topic. We're good at gleaning information out of context. So making a judgment on a management team quality, for example. Very difficult things for machines to do that. Where the machines are very good at is breadth. So machines are excellent at going and analyzing and looking at 1,000, 10,000, 100,000 different things that you haven't looked at as the human, because you just can't do that. You don't have that capability. And saying, hey, if you weigh all this information in a systematic, unbiased way, this is the one that pops up to the surface, or this is the one that pops up. So you should go look here, human. You should go look there, human. So it's all about playing to the strengths of the machine and the man, and that's what we're doing in the lab.
Very interesting stuff. I think we'll round it out there. It's a really fulsome discussion of intrinsic value, how we go about it, maybe how it might change in the future. So I want to thank you for being here, Justin.
Always a pleasure, Ken.
Good to hear. It's always a pleasure. We always end with one more thought.
Okay.
So I know you commute to work by bike.
Mm-hmm.
So I'm very curious to know what in your commute to work by bike you can link to investing.
That's actually, the audience should know that I was not prepared with this question, but it's a fun question, because I think it's actually, the link that I would make is biking to work. It's a lot of work, right? To do that every day, day in and day out. You wake up, it's so much easier to get in the car than to get on a bike for an hour and to bike, especially in minus 30, sometimes Calgary winters.
Oh yeah, by the way, yeah, there you go. Justin bikes in the winter too.
I try, and the snow is the breaking point, but yeah, so what is the similarity? I think I like the idea of just patience, of just consistency, of going out every day, day in, day out. It doesn't always feel great. It's not always fabulous and sexy and exciting and all these things, but if you do get on the bike every day, day in and day out, it has benefits, right? You feel better in the long term. You feel better that day. And I think the same thing goes with investing, is if you're just consistent, and I love this an idea of, just gradual, pebble by pebble, you make it the mountain, right? And it's very much how great success happens, is you do it one tiny step at a time, and eventually you get there.
That's an awesome answer. We could go deeper in terms of there's risks to riding your bike, but that would be a whole podcast. So thanks, Justin, for joining us. We'll have you on again soon, and really great
Sounds good.
answers.
Thanks, Cam.
Thank you.
Take care.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to more, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.